Imagine a company right now legally saving millions of dollars. Not by cutting corners, no, but by simply mastering the secret of when and where they do business. What if you could unlock that same kind of strategic thinking, turning complex tax rules into clear, actionable insights for any organization? Welcome to the deep dive, where we take your sources, peel back the layers, and extract the most important nuggets of knowledge. Today, we're diving headfirst into the fascinating and sometimes pretty complex world of corporate tax planning. Our mission to demystify the core strategies corporations use to minimize their tax liability and keep more cash flowing, which directly impacts their growth and stability. Okay, let's unpack this right from the start. We often think of taxes as, a fixed cost, something you just calculate and pay. But why do corporations dedicate so much time, energy, and resources to tax planning beyond merely settling their annual bill? Is it really that big of a deal?
Oh, it's an absolutely massive deal. And it's far more dynamic than just a simple calculation, really. At its core, corporations, much like individuals actually, are driven by a fundamental financial imperative to retain as much cash as possible within the business. This isn't about evasion or skirting the law. It's about strategically, legally, and ethically reducing their tax liability. Think of it as intelligent financial management. The cash they save through smart tax planning is crucial. It can be immediately reinvested into the business, funding R&D, expanding operations, upgrading tech, or it can be used for shareholder payouts, keeping investors happy, or strategically applied to reduce outstanding debt, strengthening the company's balance sheet. So yes, it's absolutely a critical pillar of corporate financial health. To achieve this retention of cash, corporations generally focus on three distinct yet sort of interconnected categories of tax planning strategies. First, we have timing strategies. This asks the crucial question: when should income or loss be recognized? The timing of these events can dramatically alter their tax impact. Second, we delve into income shifting strategies. Here, the focus shifts to whom or where income or loss should be allocated. Different entities or locations can have wildly different tax rates, creating significant opportunities. And third, there's the absolutely essential element of managing estimated payments and the avoidance of underpayment penalties. This isn't really about reducing the total tax, but rather eliminating those unnecessary penalty payments that would simply erode valuable capital. Now, while these strategies offer significant opportunities, it's also crucial to remember they don't operate in a vacuum. There are always practical limitations, like non-tax business conditions. You simply can't make a tax decision that's, well, detrimental to the overall business's strategic goals or operational viability. And perhaps most importantly, they're crucial judicial doctrines that prevent abuse and ensure these strategies are applied within the spirit of the law, not just the letter.
That makes perfect sense. So let's dive into the first big lever then: timing. How can simply choosing when to do something, recognize income, or take a deduction make such a monumental difference to a company's bottom line? It seems like such a subtle distinction.
It truly is subtle on the surface, yeah, but its impact can be profound. Timing strategies are all about influencing the specific tax year in which income, deductions, or credits are recognized. The core idea is to shift these items between periods, either recognizing them earlier or deferring them later. For this to work, a corporation must, of course, have the actual ability to influence that timing. You can't just magically move income if it's already fixed. The entire premise of timing strategies is built on a fundamental financial truth: the time value of money. Think about it like this. If someone offered you $100 today or $100 a year from now, you'd always take today, right?
Right, absolutely.
Because you can invest that money, put it to work, and hopefully have more than $100 by next year. That simple idea that a dollar today is worth more than a dollar in the future is the bedrock of all timing strategies in tax. Corporations apply this principle to their tax payments, aiming to get tax benefits sooner and delay tax costs as long as legally possible. It's all about optimizing their cash flow. So the goal is straightforward. For income, you want to maximize your after-tax cash inflows. For deductions, you want to minimize your after-tax cash outflows. Let's briefly look at the mechanics. Your after-tax income is simply your before-tax income minus your tax costs. Pretty simple. And for deductions, your after-tax deduction is your before-tax deduction minus your tax savings. Those tax costs or tax savings are calculated by multiplying the before-tax amount by the corporation's marginal tax rate. Essentially, effective tax planning here means strategically minimizing those tax costs to boost after-tax income and maximizing tax savings to slash after-tax expenses. It's also worth noting how tax credits fit in here. Unlike deductions, which just reduce your taxable income, tax credits reduce your tax liability dollar for dollar. They are incredibly powerful.
Okay, so a direct reduction.
It's exactly. Because of this direct impact, corporations should almost always seek to utilize any available tax credits as soon as they possibly can. Getting that immediate dollar-for-dollar reduction faster means quicker access to that cash, amplifying the time value of money principle we talked about. When we talk about timing, three key variables are always at play. First, the amount of the income or deduction itself. Obvious maybe, but crucial. Second, the applicable marginal tax rate the corporation faces. And third, the discount factor. The discount factor is essentially a way of saying that a dollar in the future is worth less to you today. Assuming a positive rate of return on investments, this factor is always less than 1. For many timing strategies that simply shift an item between one year and the next, the impact is straightforward. A dollar received or saved sooner is simply worth more. So our ultimate goal in timing is to minimize the present value of tax costs, which directly maximizes the present value of after-tax income. And conversely, to maximize the present value of tax savings, thereby minimizing the present value of after-tax expense. It's all about making your dollars work harder for you sooner.
That makes perfect sense. So $1 today for tax purposes is always better than $1 tomorrow, unless something else changes. One of the most immediate and tangible ways timing plays out is with losses. It's like having a special rainy day fund for your taxes, but you need to know precisely when and how to tap into it. Let's start with capital losses.
Precisely. Capital losses offer a classic example of a strategic timing play. To maximize the tax savings from these losses, corporations should always prioritize an immediate refund. This means carrying back any available capital loss first. The rules allow them to carry back losses 3 years, offsetting any capital gains from those prior periods. After exhausting the carryback period, any remaining loss can then be carried forward for 5 years, ready to offset future capital gains. This carryback first approach ensures the quickest possible tax reduction, getting cash back into the company's hands faster. It's just smart cash management. Let's consider a practical scenario with, let's call him Bennett Corp. In year 4, Bennett Corp generated $20,000 in capital losses from selling some investment securities. In that same year, they also had a taxable income of $100,000. Looking back at their records, they had prior capital gains: $5,000 in year 1, $2,000 in year 2, and $4,000 in year 3. Let's say the corporate tax rate was a flat 21% across all these years. So Bennett Corp strategically activates their capital loss carryback.
Then you use $5,000, their $20,000 loss against year 1's capital gain, then $2,000 against year 2's, and finally $4,000 against year 3's. This totals $11,000 of the capital loss used to offset prior gains. What does that mean for their cash? It immediately generates $2,310 in tax savings. That's the $11,000 multiplied by the 21% corporate tax rate.
Okay, so instant cash back.
Exactly. That money comes back to them quickly. The remaining $9,000 of the original $20,000 capital loss can then be carried forward, available to offset any future capital gains Bennett might realize over the next 5 years.
So what happens if that remaining $9,000 carry forward is about to expire? Does Bennett just lose out on that tax benefit? It sounds like you just forfeit it if you don't have gains.
That's where it gets truly strategic and creates a unique tax planning incentive, sometimes called use it or lose it. Because capital loss carryforwards do expire after 5 years, corporations often find themselves in a situation where they might proactively recognize capital gains. This means they might sell an appreciated asset, even if they're not strictly ready to sell it from a pure investment standpoint, simply to utilize those expiring carryforwards. It sounds a bit weird, maybe.
Yeah, selling something just to use a loss.
Exactly. Let's continue with Bennett Corp. Suppose they didn't have any significant capital gain or loss transactions from year 5 through year 8. Now it's year 9, and they still have that $9,000 capital loss carry forward from year 4 that is about to expire at the end of the year. Coincidentally, they also happen to have $50,000 in unrealized gains on other investment securities just sitting in their portfolio. The smart move here is for Bennett to realize and recognize precisely $9,000 of those unrealized gains in year 9. They could even immediately repurchase the same securities if they want to maintain their investment position, assuming, no wash sale rules apply, which often isn't an issue for corporations here. The beauty of this maneuver is that the $9,000 realized capital gain is completely offset by the expiring year 4 capital loss carryforward. This results in no current tax liability on that $9,000. They'll only need to pay tax on the remaining $41,000 of unrealized gain when they eventually sell it down the road. This is a brilliant aha moment in tax planning, proactively generating a gain to prevent the complete loss of a valuable tax benefit. It's a very clever use of timing. Now let's talk about net operating loss, or NOL carryovers. These are basically losses from a company's core operations, not investments. The tax treatment here is a bit more complex and differs significantly based on when the NOL was generated. This is key. If the NOL was generated in a tax year ending before January 1st, 2018, it could be carried forward for 20 years and could offset 100% of future years' taxable income. Pretty straightforward. However, for NOLs generated in tax years ending after December 31st, 2017, the rules changed dramatically due to the Tax Cuts and Jobs Act. They can now be carried forward indefinitely, which sounds fantastic.
Indefinitely. That sounds great.
It does, but there's a catch. They come with a crucial limitation. They can only offset up to 80% of future taxable income, and only after any pre-2018 NOLs are deducted first. And a critical rule to remember when a company has multiple NOLs is that the oldest NOL is always utilized first. This is really important for managing which rules apply when. Let's use ACE Corp as an example to see how these evolving rules play out. ACE is a calendar year C corporation. They have two significant NOL carryovers, $40,000 from 2017, that's the old rule, and $70,000 from 2022, that's the new rule. Their current year's taxable income before any NOL deductions is $100,000. First, because the 2017 NOL is the oldest, ACE Corp must deduct the full $40,000 from their $100,000 current taxable income. No limits there. This leaves them with $60,000 of taxable income remaining. Now, for the 2022 NOL, which falls under the newer rules, they can only offset 80% of this remaining income. So $60,000 multiplied by 80% equals a limit of $48,000. ACE Corp can then deduct $48,000 of their 2022 NOL. They use the full amount allowed under the limit. So in total, ACE Corp's NOL deduction in the current year is $40,000 in the 2017 NOL plus $48,000 in the 2022 NOL, totaling $88,000. After these deductions, their current year taxable income is dramatically reduced to just $12,000.
Big difference.
Huge. As for their carryforwards, the 2017 NOL is now completely utilized, so it's $0. Gone. And from the original $70,000 2022 NOL, $48,000 was used, leaving $22,000 to be carried forward indefinitely to future years, subject to that ongoing 80% limitation.
This raises an important question then. How do companies not just navigate these evolving rules, but proactively plan when the landscape can shift so dramatically?
Well, the rules for NOLs are a perfect illustration of how changing legislation directly impacts timing strategies. New tax laws, like the Tax Cuts and Jobs Act of 2017, can introduce entirely new limitations on deductions or fundamentally alter how certain income items are taxed. For instance, that 2017 tax law significantly changed how NOLs generated after 2017 were treated indefinite, carry forward, yes, but also that 80% limitation. These kinds of legislative shifts are critical because they immediately create new tax planning opportunities and, just as often, new challenges. Companies need to be incredibly agile, especially when these changes take effect right at the end of a tax year, requiring immediate strategic adjustments to their income and deduction timing. It's like playing chess, where the rules of the board change mid-game, truly.
That's a fantastic analogy. Imagine the tax landscape shifting under your feet with new laws. But what about changes in tax rates themselves? How does a simple percentage point change affect these crucial timing decisions? It seems like it would really complicate things.
It absolutely does complicate things, and it can flip conventional wisdom right on its head. While corporations in the U.S. typically operate under a flat federal tax rate of 21% right now, new legislation can certainly change that. Furthermore, state income tax changes can also significantly alter a corporation's overall marginal tax rate from year to year. These shifts are a huge factor in timing strategies. Let's consider two main scenarios for tax rates. First, if tax rates are constant or decreasing in future years, the conventional wisdom holds true. In this scenario, corporations should strategically accelerate deductions into earlier years.
Why is that?
Because you get the tax savings sooner, which aligns perfectly with the time value of money principle. Get the cash benefit faster. Conversely, they should defer income into later years to minimize the tax costs associated with that income, as those costs will either be the same or lower in the future or simply delayed. Let's use a quick example with J Corp to illustrate constant rates. J Corp receives a $10,000 bill for insurance on December 20th of year 1, but it's not due until January 31st of year 2. Their marginal tax rate is 21% this year, and they anticipate it will remain 21% next year. Let's assume a discount factor of 0.926 for 1 year, reflecting, say, an 8% return they could earn on their money. J Corp wants to minimize their after-tax costs, which means maximizing the present value of the tax savings associated with this deduction. If J Corp pays the bill this year, in year 1, the tax savings are straightforward. $10,000, the pre-tax expense, multiplied by 21%, their marginal tax rate, which equals $2,100. Since it's paid this year, the discount factor is effectively 1, so the present value of those tax savings is still $2,100.
The after-tax cost is $10,000 minus those $2,100 in savings, which means a net cost of $7,900. Okay.
Okay, $7,900.
Now, what if they pay the bill next year, in year 2? The tax savings would still be $10,000 multiplied by 21%, or $2,100. But because it's next year, we apply that discount factor of 0.926. So the present value of those tax savings is only $1,945. The after-tax cost, if paid next year, is $10,000 minus that $1,945, which equals $8,055.
Ah, so it costs more if they wait.
Exactly. Comparing the after-tax cost $7,900 this year versus $8,055 next year, it's clear that J Corp minimizes their cost by accelerating the payment and getting the tax deduction in the current year. This approach also holds true if rates were decreasing. Accelerating the deduction would still be the preferred strategy.
That makes perfect sense. Get the money back faster. But what if the rates are changing, specifically increasing? Does that flip the script?
It absolutely can, and this is where the decision becomes significantly more complex and counterintuitive sometimes. In this scenario, the increase in the future tax rate might actually outweigh the effect of the discount factor. This could lead to a strategy where a corporation might choose to defer deductions into later years, or even accelerate income into earlier years, which is the exact opposite of what you'd normally do. Let's revisit J Corp with a crucial twist: changing tax rates. Same $10,000 insurance bill, same December 20th year 1 receipt, January 31st year 2 due date. But now their current marginal tax rate in year 1 is 21%, and they anticipate it will increase to 25% next year in year 2. The discount factor is still 0.926. If J Corp pays in year 1, as before, the tax savings are $10,000 multiplied by 21%, which is $2,100. The after-tax cost is $10,000 minus $2,100, or $700 to $900, same as before. However, if they choose to pay in year 2, their anticipated marginal tax rate will be 25%. So the potential tax savings would be $10,000 multiplied by 25%, which is $2,500, a bigger saving, but it's delayed. Now, applying the discount factor of 0.926, the present value of those tax savings becomes $2,315.
Still higher than the $2,100.
Right. The after-tax cost, if paid in year 2, is $10,000 minus $2,315, which is $7,685. So in this scenario, J Corp actually realizes greater tax savings by paying the bill next year, $2,315 versus $2,100 if paid this year, and their after-tax cost is significantly lower, $7,685 versus $7,900.
Wow, so waiting saves them money here.
Yep. Exactly. This demonstrates that a higher future tax rate of 25% made deferring the expense the better option, directly contrary to the conventional wisdom. It's a powerful example of how anticipating legislative changes or economic shifts can really turn traditional tax advice on its head. So to give you a clear, actionable summary of this crucial timing principle, when tax rates are constant or decreasing, generally accelerate deductions into earlier years to get those tax savings sooner, and defer income into later years to delay tax costs. Basic time value of money. But when tax rates are increasing, you must carefully consider if that anticipated rate increase is significant enough to outweigh the impact of the discount factor. It might mean strategically deferring deductions to get a much bigger tax saving later, or even accelerating income into the current year to avoid even higher future tax costs. It's a precise calculation, a dynamic assessment, not just a simple rule of thumb. This is where real financial foresight comes into play.
That's incredibly insightful. It really underscores that tax planning isn't just about static rules. It's a dynamic chess game against an evolving landscape. We've seen how crucial when you act can be. But what if a company has operations in different states or even different countries? That brings us to our next major lever: who and where income is recognized. Because just like with timing, the geography of your business can dramatically impact your tax bill.
Absolutely. Moving from when to who and where, these income-shifting strategies are designed to exploit differences in tax rates. This can happen across various jurisdictions, like different states within the U.S., different local governments, or even across foreign countries, although international rules have become increasingly complex lately. It also applies between different entities, particularly between corporations and their owners. A common and impactful application of income shifting is in transactions between different jurisdictions, essentially choosing where to formally recognize income or expense. The general rule is delightfully straightforward from a tax perspective. You want to recognize income in jurisdictions with lower tax rates. While recent tax law changes have reduced some of the more aggressive opportunities for shifting income between countries, there's still ample opportunity within the U.S. itself. Why? Because state corporate income tax rates vary wildly.
Oh, yeah, they're all over the map.
Exactly. Some states have very low or even no corporate income tax rates, providing a strong incentive to concentrate corporate activity there. These rate differences can significantly influence a corporation's decisions about where to expand, where to locate new facilities, or even where to base their headquarters. Let's consider a company like, say, Godwin Corp. They're headquartered in New York, where the state corporate income tax rate is a notable 6.5%. Their West Coast sales are booming, so they're thinking of expanding with a new distribution center. They've narrowed it down to two options: South Dakota, which famously has no corporate income tax.
0. Wow.
0. Or Colorado, with a 4.55% corporate income tax rate. Godwin anticipates generating a total taxable income of $10 million after the expansion. Based on their business activity, 70% of that income will be apportioned to New York and 30% to the new state. From a purely tax planning perspective, the choice for Godwin Corp is crystal clear. South Dakota, here's why. $3 million of that $10 million total income will be apportioned to the new state. If they choose South Dakota, there will be 0 state income tax on that $3 million. Simple. If they choose Colorado, they'd face a state tax bill of $136,500. 3 million is multiplied by 4.55%.
That's a pretty significant difference.
It really is. The tax savings from choosing South Dakota are immediate and substantial.
That's a compelling difference just from the initial choice of state. But it's not just about that first decision, is it? What other opportunities emerge for a company once it's already operating in a lower tax environment? It feels like the strategy doesn't stop at the border.
You're absolutely right. The strategy extends far beyond the initial location choice. Once a company like Godwin has an established presence in a lower tax state, even if it's Colorado with its 4.55% rate, which is still lower than New York's 6.5%, it creates a strong incentive to explore ways to increase the apportionment factor of income from New York to the new lower tax state. Now, the apportionment factor, as you mentioned, is basically that formula states use to determine how much of a multi-state company's total income is taxable within their borders. It's typically based on factors like the percentage of a company's sales, property, and payroll located within that state. So strategically increasing any of these elements in the lower tax state, perhaps by shifting more sales or centralizing more property or employees there, means more income is legally recognized in that low tax zone, directly reducing the overall state tax burden. Furthermore, given New York's relatively higher corporate tax rate compared to many other states, Godwin might even consider the monumental step of moving its headquarters entirely to a state with a lower tax rate. Of course, such a decision involves massive non-tax issues that must be weighed, like the impact on talent acquisition, access to key markets, supply chains, and the overall business culture in a new population center. It's a huge undertaking.
Right, it's not just about the tax bill.
Not at all. But from a purely tax perspective, it's a powerful lever that's always on the table for maximizing cash retention. If we connect this to the bigger picture, these geographic decisions can genuinely shape a company's entire operational footprint and strategic direction, not just their annual tax bill. The second major type of income shifting occurs in transactions between corporations and their owners, focusing on who recognizes the income. The general principle here is elegant, really. You want to ensure the taxpayer with the lowest marginal tax rate is the one recognizing the income. This is especially relevant for privately held companies, where the owners are also often actively involved in the business. Common strategies often involve carefully structuring compensation or other payments. For instance, paying a salary to corporate shareholder employees is a classic move. When a corporation pays a salary, it gets a direct tax deduction for that compensation. The shareholder, in turn, recognizes that income, but importantly, only once, at their individual tax rate. This effectively circumvents the often discussed double taxation that can occur with corporate dividends, where the corporation pays tax on its profits, and then shareholders pay tax again when those same profits are distributed as dividends.
Avoiding that double hit.
Exactly. Similarly, corporations might choose to rent property from their shareholders or receive loans from them. This creates a deductible expense at the corporate level, while the shareholder receives rent or interest income, again, only taxed once at their individual rate. It's a smart way to manage the flow of funds and minimize the overall tax bite. Let's illustrate this with Amir and ABC Corp. Amir is a 50% shareholder in ABC Corp. And worked actively in the business. This year, ABC Corp. Paid Amir a $100,000 salary for his services, and the corporate tax rate is 21%. In scenario 1, let's say Amir's individual marginal tax rate is relatively low, maybe 12%. The tax savings to ABC Corp. From deducting the $100,000 salary are $21,000, $100,000 multiplied by 21%. The tax cost to Amir, the shareholder, from recognizing that $100,000 in income is $12,000, $100,000 multiplied by 12%. When you net those two figures, the $21,000 corporate savings against the $12,000 individual cost, the combined tax savings to both Amir and ABC Corp. Is a positive $9,000. That's cash staying in the system.
Nice, a net win.
Now, consider scenario 2. Where Amir's individual marginal tax rate is higher, say 24%, the tax savings to ABC Corp. From the deduction remain $21,000. That doesn't change. However, the tax cost to Amir now jumps to $24,000, $100,000 multiplied by 24%. In this case, the net effect to both Amir and ABC Corp is actually a $3,000 net tax cost, $21,000 savings minus $24,000 cost.
Ouch. So it actually costs them more overall in tax. This really highlights just how critical the individual's tax declaration is in corporate planning. It's not a one-size-fits-all approach, and a seemingly simple decision like paying a salary can have wildly different outcomes depending on the specific rates involved for both the company and the shareholder. It's a constant optimization problem.
It truly is. And beyond these straightforward strategies, corporations and their owners must be very, very cautious about potential adverse tax consequences when dealing with non-cash property, especially if it has appreciated significantly in value. Things like land or buildings. Contributions or distributions of appreciated non-cash property can trigger unexpected and immediate tax liabilities for both the shareholder and the corporation, if not handled precisely according to tax law. For instance, if a shareholder contributes appreciated non-cash property, say a valuable piece of land to a corporation, they usually want that transfer to be completely non-taxable under what are known as Section 351 rules. These rules are designed to allow individuals to move assets into a newly formed corporation, or one they already control, without immediate tax consequences. Sounds good. But if the shareholder doesn't meet the crucial 80% control requirement in the corporation immediately after the transaction, then they must recognize a gain. It's a strict rule.
Let's imagine Jason, who owns a mere 1% of XYZ Corp., contributes land with a $10,000 basis but an $80,000 fair market value in exchange for 5% of the corporation's stock, also valued at $80,000. Because Jason ends up with only 5% control, far less than the 80% required for Section 351, that deferral isn't met. So Jason immediately recognizes a $70,000 gain, $80,000, stock value minus $10,000 basis in land, that he has to pay tax on right away.
Even though he didn't really sell the land?
Correct. He has to pay tax on that gain, even though he hasn't sold the land to an outside party for cash. Similarly, if a corporation makes a non-liquidating distribution of appreciated non-cash property to a shareholder, meaning it's not winding down, just distributing an asset, the corporation itself must recognize a gain on that distributed property. Imagine XYZ Corp. distributes that same land, which still has a $10,000 basis to the corporation but is now worth $80,000 to Jason as a dividend. The corporation would recognize a $70,000 gain, $80,000 FMV minus $10,000 basis, and that gain is taxable to the corporation. On Jason's side, while he receives a tax basis of $80,000 in the land, he must also potentially recognize $80,000 in dividend income to the extent of the corporation's earnings and profits, or E&P. E&P is essentially a measure of a corporation's economic capacity to pay dividends, sort of like retained earnings, but calculated for tax purposes.
So potentially tax at both levels.
Potentially, yes. A double layer of taxation. Once for the corporation on the gain, and again for the shareholder on the dividend. Overall, these rules generally discourage both the contribution and the distribution of appreciated non-cash property for tax purposes if the specific deferral requirements for these sections of the tax code aren't fully met. It's a common trap if not planned extremely carefully.
Wow, that's a minefield. It sounds like you really need to know the specific rules inside and out, because a misstep can definitely cost you. Okay, so beyond just reducing the total tax, it's also about managing the flow of payments throughout the year. Avoidable penalties can quickly erode those hard-won savings. This brings us to estimated tax payments and preventing those underpayment penalties.
You're hitting on a crucial point about cash flow management, exactly. Effective tax planning isn't just about the ultimate liability. It's also about strategically managing when and how that cash leaves the business. Generally, corporations with an anticipated tax liability over a small threshold, usually just $500, must make quarterly estimated tax payments. These payments are typically due on the 15th day of the 4th, 6th, 9th, and 12th months of the corporation's fiscal year. Each payment is supposed to be 25% of their annual required payment to avoid penalties. Now, here's where it gets interesting for corporations trying to manage their cash flow. The minimum annual required payment is the lowest of three possible amounts. First, it can be 100% of the current year's tax liability. You basically estimate what this year's tax will be. Second, it can be 100% of the prior year's tax liability. But there are crucial limitations here. Large corporations, generally defined as those with over $1 million in taxable income in recent years, can only use this prior year method for their first quarter payment. And no corporation can use it if they had zero tax liability last year. And third, it can be 100% of the estimated tax liability for the current year, determined by using a method called the Annualized Quarterly Taxable Income Method. This method allows companies with uneven income throughout the year to adjust their payments, often reducing early payments.
Okay, so how do they choose which one to use?
Well, corporations often default to using the prior year's tax liability for their first quarter payment, unless they're a large corp expecting much higher income, or they had no tax last year. It's often the simplest. If a corporation has relatively steady income throughout the year, they might just use their estimated current year tax liability and divide it into 4 equal quarterly payments. Simple enough. But if income is not earned evenly across the year, which is incredibly common for many businesses, then corporations will almost always use the annualized method to calculate their remaining estimated tax payments. This allows them to pay less tax earlier in the year if their income growth is backloaded, optimizing their cash flow significantly. Let me explain the annualized method briefly. It essentially projects what the full year's tax would be if the income generated so far continued at the same rate for the rest of the year. Since estimated payments are due 15 days after the quarter ends, the annualization calculation for a given quarter typically lags 1 quarter, meaning it's based on the income from prior periods.
The annualization factor is obtained by dividing 12 by the number of months of income considered. So for Q1 and Q2 payments, it's based on M13 income, factors 123. For Q3 based on M16, factors 126. For Q4 based on M19, factors 129. You multiply the income earned in that period by the annualization factor to get your estimated annual taxable income, then calculate the tax on that. The corporation then compares that tax liability to confirm they've paid the required percentage by that quarter's due date. 25% for Q1, 50% for Q2, 75% for Q3, 100% for Q4. It's a bit like driving with a forecast, not just looking in the rearview mirror. Let's walk through an example with Simon Corp to see this in action. Last year, Simon had $10 million in taxable income and a $2,100,000 tax liability based on a 21% rate. This year, their income is a bit lumpy, as it often is. Q1, they had $5 in taxable income, Q2 only $1, Q3 get it at $6, and Q4 hit $8. Simon's goal is to pay the absolute minimum estimated tax payments possible to avoid penalties, keeping cash for working capital. For their first quarter estimated tax payment, Simon Corp earned a significant $5 hours.
If they annualize this, they'd be on track for $20 and $5 by $123 in income this year, meaning a much higher tax bill than last year. So to minimize the immediate cash outflow, Simon smartly uses the prior year's tax liability rule. Their first quarter payment is 25% of last year's $2.01 in tax liability, which is $525,000. It's the lowest required payment for that quarter.
Smart move. Keeps cash in hand.
Exactly. Now for the second quarter estimated tax payment, Simon, being a large corporation, can no longer use the prior year tax liability rule after Q1. They must switch to the annualized method. For Q2, the annualization is based only on their Q1 income still. So $5 in income for months 1 to 3 multiplied by the 123 annualization factor gives them an annualized taxable income of $20. The tax liability on this annualized income of 21% is $4.02. By the end of the second quarter, Simon must have paid in at least 50% of this annualized tax, which is $2.01. Since they already paid $525K in Q1, the required second quarter payment is $2.01 minus $525K, which equals $1,575,000. Moving to the third quarter payment, Simon again uses the annualized method, but now it's based on their cumulative income from months 1 to 6. That's $5 Q1 plus $1 Q2, totaling $6. Multiplying this by the 126 annualization factor gives an annualized taxable income of $12. The annualized tax on this is $2.52. 12 million is 21%. By the end of the third quarter, Simon must have paid in at least 75% of this amount, which means they needed to have paid $1,890,000 cumulatively. However, by the end of Q2, Simon had already cumulatively paid $525K plus 1.475 meters, totaling $2.01. Since $2.01 is more than the required $1.89.
So they're ahead.
Exactly. There is no required third quarter payment for Simon Corp. They're actually in a position of overpayment relative to the minimum required at that point, giving them a cash flow advantage. Finally, for the fourth quarter payment, Simon annualizes based on income from months 1 to 9, that's $5 Q1 plus $1 Q2 plus $6 Q3, totaling $12. Multiplying by the 129 annualization factor, their annualized taxable income is $16 on this. The full 100% of the tax on this amount, $3.36, $16 by 21%, must be paid in by the fourth quarter due date. Since Simon had already paid a cumulative $2.01 by the end of Q3, the required fourth quarter payment is $3.36 minus $2.01, which is $1,260,000. It's a dance to balance compliance with cash management. And it's important to note that the fourth quarter's actual income, that $8 in this example, is never factored into these quarterly estimated tax payments. Any outstanding tax liability from that period is simply settled when the corporation files its annual tax return. This method really allows corporations with fluctuating income to maintain healthier cash reserves earlier in the year.
That's a masterclass in cash flow management. It really shows the strategic dance involved, making sure you're paying just enough, but not too much, too soon. It's a constant balancing act to avoid those penalties while keeping capital available. So we've explored the power of timing, of who and where, and managing payments. But it's not all open season, is it? There have to be important guardrails and realities that limit how far these strategies can go. You can't just operate in a tax vacuum, right?
Absolutely not. While tax planning is a powerful tool, it operates within very real and crucial limitations. One common limitation is simply the lack of opportunity. If a corporation doesn't have accrued loss carryovers to utilize, or if they genuinely lack the ability to influence the timing of a particular income or loss event, or if they can't determine which entity truly recognizes the income or loss for legitimate business reasons, then tax planning in those specific areas simply isn't feasible. You need the underlying economic or structural conditions to even begin. Perhaps even more critically, corporations must always consider non-tax business conditions. A tax planning strategy, no matter how brilliant it looks on paper and how much it promises in savings, must ultimately make good business sense overall. If a strategy saves you a lot in taxes, but simultaneously creates significant financial distress by, say, tying up too much crucial cash, or negatively impacting customer relations, or damaging your brand reputation, or even running afoul of other regulatory bodies, then it's simply not effective tax planning.
Right, the tail can't wag the dog.
Precisely. Business viability, strategic objectives, and operational efficiency always come first. Tax optimization is a tool to support the business, not to dictate its fundamental direction. Beyond these general practical limitations, there are also crucial judicial doctrines. These are principles developed by courts over time, not necessarily written explicitly in the tax code in black and white, but designed to prevent abuse and ensure that transactions are taxed based on their true nature, rather than simply how they are formally structured. They are the IRS's big guns, so to speak. One such doctrine is the constructive receipt doctrine. This doctrine primarily limits timing strategies by stating that income must be recognized the earlier of when it is physically received or when it is constructively received. Constructive receipt means the income is made available to the taxpayer without restriction. For example, imagine a company's executive has earned a bonus. If the company sends the bonus check in December, but the executive deliberately waits until January to pick it up, or deposit it to push the income into the next tax year.
They're trying to game the system.
Exactly. The IRS can argue constructive receipt. Those funds were made available in December, provided the check was ready, backed by sufficient funds, and the amount was accurate. So you can't simply delay picking up a payment to defer income for tax purposes. The law looks at when you could have had it. Then there's the assignment of income doctrine, which primarily limits income shifting strategies. This doctrine asserts that income must be recognized by the taxpayer who earned it, or in the case of unearned income from property, by the taxpayer who owns the property that produced the income. For a corporation, this doctrine makes it significantly more difficult to simply shift income between different taxpayers or entities purely for tax benefit if those entities weren't the true earners or owners of the income-producing property. You can't just assign your consulting fee to a lower tax-related entity if you were the one performing the service. The income follows the earner. It prevents artificial income rerouting. Finally, we have the Brader substance over form doctrine, which often includes the step transaction doctrine. This is perhaps the most powerful and encompassing judicial doctrine. It allows the IRS to look past the form in which a transaction is structured and instead determine its true substance or underlying economic reality. This means they can disregard individual steps in a series of transactions and collapse them into a single integrated transaction to determine the actual tax consequences, regardless of how they were ostensibly structured.
So they look at the big picture outcome.
Exactly. If a company breaks down a single sale into 3 tiny, seemingly separate transactions to avoid a certain tax, the IRS can use the step transaction doctrine to view it as one large sale, applying the correct tax. This doctrine encourages critical thinking about the true nature and intent of every transaction, not just its legal appearance. It's a powerful tool for preventing abusive tax schemes that rely on complex, artificial structures that lack real business purpose beyond tax avoidance.
So what does this all mean for you, whether you're managing a small business or just interested in how the corporate world works? We've journeyed through the intricacies of corporate tax planning, uncovering the strategic choices that allow companies to optimize their financial position. It's clearly much more than just filling out a form. It's a sophisticated interplay of timing, location, and entity structure.
Yeah, and if we connect this to the bigger picture, understanding these levers, timing, income shifting, and payment management, isn't just about saving money in the short term. It's about intelligent financial stewardship that enables corporations to retain capital. This retained capital is vital. It can then be reinvested into critical areas like R&D for new products, funding strategic expansion into new markets, supporting job creation within communities, and driving technological innovation that potentially benefits us all.
Yeah.
Ultimately, these sophisticated strategies directly shape a company's long-term viability, its competitive advantage, and its broader economic impact. It's truly a fundamental and dynamic aspect of corporate finance that affects everything.
Consider this. How might these sophisticated corporate tax planning strategies influence not just a company's immediate financial decisions, but also its broader strategic choices? Things like where it chooses to operate globally, or how it structures internal incentives for its employees, or even what kind of new products it decides to launch. The tax code truly impacts every corner of the business world in ways most of us never even consider until we take this kind of deep dive.